We are going to the chapter we are supposed to discuss today. That's where I'm going to. Okay. Chapter I'm supposed to discuss today is where I'm going to. The chapter I'm supposed to discuss today is substantive procedure. All right. Remember the last time we met, I was able to explain to us, we were able to discuss on test of controls. Okay. But this, in test of controls, right? We're able to discuss extensively on that, right? So tonight, we'll go to substantive procedure. The introductory aspect would be handled by the second facilitator. That's where I'm looking at where I'm supposed to start from. All right. So this is where I'm starting from. I hope you can see. Substantive procedure, non-current assets. Let me give us a background to what we are discussing tonight. Now, remember when we started, when we had the last class, I made mention of the fact that even when we're looking at audit evidence and sampling, I made reference to the fact that when the external auditor comes to the organization, to the client organization to audit, right? I made mention of the fact that there are audit tests that need to be performed by the external auditor, all right, to see whether he can rely on the evidence, that evidence from is going to get from the client's financial reporting. Okay. Now, as I mentioned that those tests are, and I said that those two tests have been replaced. If you use any, if this exam you want to write November 2025, it will be suicidal if you go and use substantive testing and compliance testing. The two tests, their names have changed to test of control, which replaces the compliance testing, and the test of detailed transaction, that replaces the substantive testing. Okay? And we discussed at length on test of control in the last class. So tonight, we are going to the other test. Now, what you need to remember, I also made mention of in that class is that there are instances when you have, apart from those two tests, there's another test that can also be performed, which is known as what? Substantive procedure. And remember when I made mention of substantive procedure, I said that is the combination of test-related transaction and analytical review procedures. Okay, so I'm giving us a background to where we are coming from before we start this class because you need that information from the last class, right? That I just explained now, be able to catch up with what we will be doing tonight. If I were to be the one that will take us the introductory aspect of substantive procedure, there will not have been any need. Okay, but there is no issue. I've given us a background to what we are discussing tonight. So when the sales facilitator comes on board to take you substantive procedure, at least you will have had some insight, okay? You'll have had an in-depth understanding of what substantive procedure is. I hope you understand. So that is the introductory aspect, or I would say uh, the overview of what we'll be discussing tonight. Now, one thing you also need to realize is that, like I said, after you have performed the test of control is a test that is performed in order to check whether the internal control system is efficient and what effective, right? While the test of detailed transaction is a second test, is another level of test that further gives reasonable level of assurance such that the auditor can do what? Can verify, okay? Verify, vouch transactions, verify asset liabilities, vouch transactions to be sure that those transactions and account balances presented in financial statements actually exist. Okay, so when you are asking for, let me have the payment voucher, let me have your your asset schedule, let me have your purchase schedule, let me have your sales schedule. When you are asking for all of these things, what you are doing is what is known as what? You are performing tests of detailed transaction. All right. So in substantive procedure, right, is another level to also checking that the risk of material misstatement in financial statement is what? is reduced or has reduced drastically. Okay. Now, substantive procedure, as the name implies, it cut across the entire financial reporting. Why did I say so? We are going to talk about substantive procedure as relates to non-current assets, as relates to current assets, as relates to other aspects of the world of the financial statement. Okay. But for this night, we'll be discussing on substantive procedure for non-current assets. We're talking about what? Substantive procedure for what? For non-current assets. All right. Now, remember that the non-current assets, right? They form part of the statement of financial position, right? Now, what you also need to realize here is that these non-current assets, they are highly susceptible to what? Manipulation. That is, there is high risk of material misstatement that can occur with the non-current assets. And I gave that instance when you are looking at audit risk. Okay, now I'll still explain it here. There is a risk of material misstatement that can occur when you are doing what? When you have your non-current assets. And these are some of the things that can lead to it. Number one, your non-current assets. If you go to your IAS 36, it talks about what? Impairment. What do you say about impairment? That is, at least once a year, you must test your what? Assets, non-current assets, okay, against what? Impairment. So when you fail to do that, what that implies is that the current amount you have in your financial statement might either have been what? Overstated or what? Understated. Thereby what? Thereby presenting a risk of material misstatement in the what? Financial reporting. Okay, if you don't carry out that test, okay, the impairment test. All right, that's one way, and that's one way, except for land, that's one way can go a long way in what? In misleading the owners of the business or the shareholders or other intelligent users of the what? Of the audited accounts and what? Reports. Okay. Now, in order for us to ensure that non-current asset that is depicted in the statement of financial position is free from the risk of material misstatement, right? These are some of the measures or procedures that need to be carried out to validate that those balances you have in the asset schedule actually what? Actually exist. Okay? So, number one, you need to look, first of all, in your statement of financial position, right? There's a need to disclose the basis used to revalue assets. Now, there are times when you need to revalue your asset, especially if the asset does no longer show does not represent economic reality. You might need to what? Revalue your asset. For instance, if you have motor vehicle, Toyota Corolla 20, 2008 in your financial statement, as far back as, let's say, like 3 years ago. Now, 3 years ago, your Toyota Corolla maybe it cost around 3, 4 million as at that time. But as it is today now, the Toyota Corolla 2008 goes for what? 10 million naira. It goes for what? 10 million naira. So in this instance, there might be need for you to do what? To revalue your assets. Why did I say so? Now, let's say, for instance, your organization, you have already taken insurance cover for the assets. And those assets, Toyota Corolla is part of those assets. And unfortunately, there was a robbery or there was a theft, and that car, Toyota Corolla, got stolen. You have been paying insurance premium on the value of what? 4 million naira before now. So if the car gets stolen, how much do you think the insurance company will pay you as what? As claim after deducting all the deductibles? How much do you think they are going to pay you? They're going to give you something like 3.5. Now, if you have 3.5 million, can you use that money to buy another Toyota Corolla, even if it's second hand? The answer is no. That's the reason why you need to do what? You need to what? Revalue your assets. You need to know the basis used for the evaluation of what assets. Number two, you also need to give us, you should also be able to determine the date when the assets were revalued. So these are the questions the external auditor will be asking the client management when it gets to what? Perform substantive procedure for non-current assets. All right. The auditor will also be interested in whether an independent valuer was involved in the what? In the revaluation. We want to see that it's not the external auditor that still performed the revaluation. If it's the same auditor, if the auditor that audited the company that also performed the evaluation, that means there might be some what? There might be some issues because that means there could have been some Um, what do I call it now? Conflict of interest on the part of the auditor, or it can also affect what? The objectivity of the what? The evaluation exercise. Then the auditor will also of any cost index that was used as a basis of what? Calculating what? Replacement cost. I just explained what replacement cost is now. That is, in case you lose that asset, how much will it cost you to buy or to replace that asset? That's replacement cost. Okay. Then you need to also know the current amount of each class of asset that would have been reported if the asset had been what? Reported using the what? The cost method. Okay. The asset has been done using what? The cost method. Okay. And so if the asset had been valued at cost minus accumulated depreciation. So you can either use cost method or you use the what? You use evaluation method. Okay. Now, in addition, a note should disclose the basis used for the depreciation. So if you look at this, the note to the account, you must have the basis used for what? Depreciation of each asset. In fact, it's one part of the notes information contained in the word note to the account. So when non-current assets are a significant item in the financial position of the company, disclosures relating to them are therefore both extensive and of some significance in terms of what? Obtaining audit evidence. Now, that is just some of the information that you need. Now, like I said, the whole essence of this substantive procedure is to reduce the what? The risk of what? Material misstatement in the what? In the financial statement. So some of the principal risks of misstatements of non-current assets are, so number one, remember we look at financial statement assertion in chapter 6, that is audit evidence and sampling, where I buttress on what we mean by financial statement assertion. And I said that the financial statement assertion, there are three types, right? The first one is assertion based on transactions and events that relates to our statement of profit or loss, another comprehensive income. Then we have the second assertion that we call assertion based on what account balances that relates to our statement of financial position. And we have the third one that is known as what? Assertion based on what? Presentation and disclosure that relates to both of them. That is both statement of profit or loss and statement of financial position. Now you are looking at the non-current assets here. So invariably, what that implies is that the assertion you'll be considering in this instance will be what? The assertion based on what? Account balances, because that speaks to what? The statement of financial position. And if you go back to that assertion, there are four assertions that the auditor will need to test. Okay? The first one is what? Completeness. The auditor wants to know. The auditor wants to know. Because manager said that everything in that financial statement is accurate, is correct. The auditor will now perform the test. We test those assertions, whether those assertions that the management made are what? Actually correct. So the first one, they will say that the financial statement is what? Is complete. So the auditor will test the what? The completion assertion. So there's a risk that assets owned by the reporting entity might not have been included in the what? In the financial statement. There might be some assets that they have not captured while preparing the financial statement. So that will show that the completeness assertion has been what? Has been flawed. Okay? So you understand what I'm saying? So if you're supposed to have captured an asset in your books, for instance, let's say the year end of the organization, the accounting period is 1st January 2024 to 31st December 2024. Okay. and you have in your asset schedule, right? You have had some assets on that schedule all the while. But the accountant that prepared the financial statement forgot to include an asset that was bought in November 2024. Or could be that the asset was bought in January 2024, but because all the supporting document for that asset, let's say property, plant and equipment, has not been available, has not been made available to the accountant or the CFO. What did he do? He still thought that okay, until when I get the information, the actual cost, the other incidental cost of putting that asset to use, so that's when I can recognize it. Okay. So if that is the case in that instance, that means that they have omitted, or the completion assertion as what has been defeated, does not hold true any longer. Okay, does not hold true any longer. That's what we mean by the completeness assertion. Then you also need to check the what? The existence assertion. That is, there is a risk that assets reported in financial statement do not actually what? Exist. They need to test the what? The whether those assets that they have prepared in the statement of financial position actually what? Actually exist. Is very, very, very important. Okay? Whether the asset actually what? Exist. And that's the reason why when external auditors go to audit any client, what do they do? They carry out what we do as what? Asset verification. They will go around all the assets, taking the asset schedule, or taking the asset list and verify whether this asset actually exists. For instance, maybe in the course of the year, one of the motor vehicles has been dashed out to a retiring director, but they forgot to what? To remove the assets from the what? From the asset schedule and from the asset list. So the auditor said, I saw this car last year. But this year I came, I cannot find the car. What happened to the car? The CFO, sorry, we forgot. In the course of the year, one of their directors resigned, and that was a gift that was agreed to be presented to the retiring director. So that is one thing the auditor will now check the existence assertion. The other one that the auditor will also be interested in is what? Right and obligation assertion. I remember when we look at this in chapter 6, I said that right is to what? Asset. Why obligation is to what? Liability. And I said what is an asset? Asset is anything that you can use to generate what? Economic benefit is an asset. Whatever you can use to generate what? Economic benefit is what? Is an asset. Whether it is owned by you or it is hired or it is on leasehold. Okay? Now, under this right and obligation assertion, there's a risk that the reporting entity does not actually own the assets that they are included in the financial statement. So if you have leased an asset from a lessor, are you going to put the cost of that asset in your books? The answer is no. What do you recognize in your books is the lease rental that you pay, because you don't own the asset in the first place. What you are going to include in your asset schedule, right, will be the what? The lease rental that you pay. Okay, that's what you are going to what? Recognize. Now, all the other liabilities, for instance, there are loans, there are long-term loans, there are short-term loans. The author will request for the loan agreement, the loan documentation, to be sure that those loans actually is for the what? Is for the organization, is for the client. But sometimes it could not be for the client, we just try to use it just to perpetrate a fraud. So the auditor has a duty, right, to request for the loan agreement to determine whether those loans are actually for the client. Okay. Then some other assertion is also going to test is the presentation and disclosure assertion. Remember, I said that the presentation and disclosure assertion relates to both statement of profit or loss and statement of financial position. So under the statement of financial position, the author will be testing the assertion and disclosure, I mean, presentation and disclosure assertion That is, there is a risk that some assets have not been correctly what presented and disclosed in the what the financial statement. So the auditor is expected to be sure that all the assets that ought to have been included in the asset list, as well as the asset schedule, have been what have been captured and they have been what they have been properly disclosed. Okay, so the auditor can use substantive procedure to obtain evidence that the various assertions relating to tangible non-current asset awards are valid. Okay, so these are the principal risks of misstatement of what non-current assets. Any questions so far? Question, comment, observation, contribution? Are we good to go? Can anybody
Yes,
hear me?
sir. Yes, sir.
All right,
Yes, can
thank
hear
you.
you.
I take that as everybody is on the side that I continue. All right, so those are the principal risks that you can face when you try to look at the risk of financial misstatement, considering the non-current asset. Now let's take it further. Let's look at substantive procedure for tangible assets. Now, for tangible non-current assets. Now, we know we have tangible non-current assets. So let's look at the substantive procedure. The substantive procedure used by the auditor for tangible non-current assets will therefore be designed to obtain sufficient and appropriate audit evidence about the what? About the assertions. So the test will therefore be directed to, just like I said, completeness, okay, existence, okay. Existence is what? The physical inspection, okay, and you look at it from the angle of what? Valuation. Okay, you look at it from the angle of what? Valuation. So either you look at it from at cost, as you look at it from what? From the cost point of view, okay, including all the costs. You're looking at it at cost, you're going to include all the incidental costs, including that asset to use, okay. Then you need to also review allocation of expenditure between current and what capital expenditure, okay. At valuation, okay, you can also look at it from the angle of verify amount in financial statement with the valuer's report. So you look at what do you have in the valuer's report. That is the practitioner that performed the valuation. Okay, the revaluation. Look at what do you have in that valuer's report to compare it with what you have, whether it's the same thing as what they have inputted in the statement of financial position. Then you consider the reasonableness of the valuation. Sometimes the valuation might be so ridiculous. So you have to ask for what? The assumptions behind the assumption used to arrive at the what? At the valuation. Okay, they need to also check that valuation are regularly what? Updated. You need to look at when was the last time that the valuation was done. Okay. Then you need to also check the accounting for the rise or fall in value on revaluation. Okay. So you need to also check that. Okay. Because sometimes due to the forex, if you are buying an asset from outside Nigeria, the cost might vary from time to time. Okay. Then that's for the first aspect. That's when you're like looking at the what? The entire non-tangible non-current assets. Otherwise called the what? The fixed asset. Okay. Then you look at depreciation and what? Impairment. Now, impairment and depreciation, they also form part of the what? Part of the statement of financial position. So the auditor will need to review the depreciation rate for reasonableness in the light of the nature of the asset, its estimated useful life, and residual value. The we need to look at what's the rationale behind the depreciation rate that has been used. For instance, this normal standard, now normal practice is that motor vehicle is usually what? 4 years. Now, if you now look at the client's motor vehicle, theirs is what? 2 years or 3 years or 5 years. You need to be able to ask them to justify. If you look at the reasonableness in the light of the assets for that organization, Okay. You need to also ensure that consistent depreciation methods are in use. What that implies is that last 2 years they use some of these methods. This year they use reducing balancing method. Last year they use a straight line method. What does the policy say as far as uh, consistency is, which is a principle, okay, in accounting that says that the policy should be applied what consistently, okay. Therefore, we check that those inflation policy have been applied consistently from time to from the comparative to the current year under review. Then where there are disposal, the auditor will also want to review whether there are gains or losses on what on disposal. Okay, and also in that line also or in that way, you also be interested in what accumulated depreciation and impairment at the time of what disposal, because those ones would be deducted from the value of the what of the asset before you now talk of whether there is a gain or there is a loss on disposal. All right. Then you consider the possibility that assets are obsolete or suffering impairment. Now, one major problem with non-current assets is that some non-current assets they are susceptible to what? Obsolescence. What is obsolescence? When an asset, okay, becomes technically out of use, becomes what? Technically out of use. So that means that in a way, right, the functionality would have what? Would have reduced because maybe there is a newer version or there's an updated or upgraded version of that same asset. A good example, right, is if you are auditing a client that is into what? Into phones manufacturer, I mean phone sale or phone disposal or phone, yes, phone sales. He sells phones, okay? Somewhere like slot that sells phone. Now, for slot, right? One of the risks that you'll be facing from time to time is the obsolescence. Why did I say so? Now, iPhone 17 or iPhone 18 will soon be out now. When it comes out, all the other versions of iPhone becomes what? Obsolescence. Not that you cannot use them again, but automatically the value will drop. For instance, now, iPhone 16 Pro Max will be selling for 2.5 million naira now. When the new iPhone comes out now, let's say between now and next month, that phone might drop to iPhone 16 Pro Max might drop to 1.5 million. Why this new one that is coming on board might be what 3 point something million or 4 point something million. So technically, that if the other phones they have in the warehouse have become what? They have suffered from what? Obsolescence. Okay? They have suffered from what? Obsolescence. So obsolescence, what we mean by obsolescence doesn't necessarily mean maybe uh the asset is no longer in use. It can still be in use. But what that implies is that sometimes, even though it's still in use, but the value, the economic value of such assets would have what? Would have reduced. Okay? I hope you understand. Any question? Any question?
Yes, sir. Sir, please, sorry to take you backward. The part of
You have a question?
yes, can you hear me?
Please go ahead with your question.
Yes. So the
Please go
beginning
ahead. I
part
can
of
hear you.
the beginning part of the substantive procedure for tangible non-current assets, the point of valuation, is it that they measure it like I don't understand, like I'm listening to what you're saying and at the same time I'm looking at what is in the material. I don't understand that part where you gave instances of land and building, equipment and motor
I didn't
vehicle.
get you. I didn't get your question. Can you rephrase your question, please?
Okay, so the beginning part
I can't.
okay, so the beginning part of the substantive procedure for tangible non-current assets where you started with the valuation and there are instances of the land and
Yes.
building, equipment and motor vehicle. And I'm not sure I understand that part.
Which one? Where is that? There's no
You
place like land
mentioned
and
something
building. Where?
about
Where's
I'm for tangible non-current assets.
Mm-hmm.
For substantive procedure for tangible non-current assets, the valuation points you
Mm-hmm.
gave, I'm not quite sure it's not clear to
The
me.
valuation point. What valuation point I said?
The valuation, you
Are you
mentioned
not
something about
joining?
value. No, I've been here since when you started now with the non-current assets.
What I said
I'm
is
talking
this.
of
I
the,
said I can barely hear you. Hold
can you
on.
hear me now?
Let me try and rephrase what you have said. Just hold on. Let me try and rephrase what
Okay.
you have said because we don't have time. What you are saying is this, that when this first aspect that I was trying to explain, where we are now, this place, you did not get what I was
Yes,
saying there. Is that what you are saying?
the not that part.
Which part? This is the beginning. That's where we started from. See this part you are talking about?
After the
Because
risk,
I want to know where you are talking about.
after
I
the
don't want
risk.
to just be explaining. I want to know where you are talking about. Is it this part the only place we have looked at since we started? I started with the introduction. Where,
Yes.
where
So the substantive procedure for tangible non-current assets, you mentioned something
I'm listening to
about
you.
completeness.
Tangible non-current assets. Okay,
For
hold on.
tangible non-current
Is it this one you are
assets,
talking
yes.
about? Hold on. Is it this one? This one you are talking about?
Not the
This
risk, the
side, right?
next one. Yes, sir.
This is it now. Can you see my screen?
Yes, I
This side,
can
right?
see it.
That's why I'm highlighting. Is it this side?
Exactly. Yes,
This is the side you are talking
something
about.
about valuation.
Which one is not
Yes.
clear there?
The valuation.
What about valuation is not clear. Okay.
So
What I said is this. I said that, okay, I'm listening to you.
no, I'm listening to you because I don't understand the part of the valuation part. I understand completeness, I understand the
Okay,
existence, but when you started mentioning
okay,
something about valuation, I don't understand that part.
okay. What I said is this. I said that for valuation or evaluation, let's take it from evaluation. Now, when an asset, let's start from evaluation. Now, an asset that you bought, and I use an example of a motor vehicle, Toyota Corolla, as specific. You bought Toyota Corolla 3 years ago. The price of Toyota Corolla 3 years ago is not more than 5 million. Okay? Now, let's assume that your Toyota Corolla in your books is supposed to be for 4 years. So what I'm saying is that by the end of this year now is the fourth year, and you still carry it in your books as what? As 5 million naira. So there might be need for you to carry out what we know as what? Perform what? Impairment test. Is the impairment test that is going to lead to whether you are going to do the evaluation or not. Because that means that the value you have in your books right now, the carrying amount of that asset in your books is lesser than what's supposed to be because of what? Because of the impairment that has the asset has what? Has suffered. And I'm saying now that your Toyota Corolla, as this year is concerned, 2008, Toyota Corolla goes for almost 10 million naira. And I was giving an instance is that if you let's say the value of the car, the Toyota Corolla you have in your assets now, in your financial position, is just 1 year to go. You bought it for 5 million naira. So approximately you're having like 1.250 in your book. And I'm saying that what if there's an incident that the car gets stolen? If the insurance pay you the value, let's say 4 million naira or 5 million naira, and you use that 5 million naira to purchase the type of Toyota that got stolen? Can you answer the question?
No, you cannot.
Thank you. You can know. What do you need to do? So what you need to do is after you have performed the impairment test, you need to what? Pass some adjustments in your books to ensure that the value you carry, the carrying amount of the asset in your books reflect the economic reality. So that means that your premium, I mean, the insurance premium you are going to pay on the motor vehicle will also increase because it's going to reflect the new uh, value. Do you understand? It's going to reflect what? The new value. Can you hear me?
Yes, sir, I can hear you. Thank you, sir.
Hello?
Yes,
Hello?
sir,
Can
I
you hear
can hear
me?
you. Yes, I can hear
Please
you.
respond so that I can know you
I
can hear me,
can
so that I
hear
know
you.
that you
I've
have
been
not.
talking. I said I
Thank
can
you.
hear you.
Thank you. Okay. So that is what you are going to do in that instance. Is that clear now?
Yes, it's clear. Thank you, sir.
Good. Now, and I'm taking it to the next point now. So because as the auditor does not know that they have carried out the evaluation on the asset. But how you get to know is when he looks at what? When he looks at the financial statement, that's even financial position, he's going to see that the value of the asset as at last year and this year, because in the financial statement, you are going to have comparative, the last year and the year that is under review. You see that there's a sharp difference in the two values. And that's where it's going to start asking questions. So when you see that the value was for last year was 1.250, and this year now is about 7 or 8 million naira, you need to ask questions. Do you understand? When he's asking questions, these are some of the questions you'll be asking from the is management that is responsible for the preparation of what the financial statement. I hope you understand that. Hello? Hello?
Yes, sir,
Can you
we
hear me?
can hear you. It's clear, we can hear you, sir.
No, I'm talking to the person that asked the question. The person that asked the question, I want her to answer. Because I want her to be in the
So I've
same
been, I've,
position with every other person.
yes, it's clear. I've been talking. You probably did not hear me.
Okay, maybe you mute your mic. So I'm still explaining. So the auditor will be asking questions from the what? From the management. That is, you did the revaluation. Let's see the valuer's report. Because valuer report, we have a what? The report and the amount that is the certified amount that's supposed to be taken into cognizance in the what? In the same financial position. That's why they don't want to see the proof that the valuation was actually done, but was not just a figure that was randomly what? Put in the same financial position. It needs the what? The documentary what? Evidence. You also need to ask that, okay, you have done the valuation. In the valuation report or the valuer's report, you also be checking what is the basis? How reasonable is the valuation that has been used? How reasonable is the valuation that has been used? The other thing you also need to look at is that how frequent do they carry out this valuation? Because as it is, IS 36 says that impairment should be tested to be carried out every once a year, at least once a year. We want to see that are they being consistent in carrying out this impairment test? Are you with me? The test, you have you have made the adjustment. Have you passed necessary journals? Have you passed necessary postings in your in your financial statement where you're supposed to, let's say there's a surplus or there's a loss on evaluation? Have you passed necessary adjustment? I hope that is clear now.
Sir.
Hmm? They are clear, right? Let's move on.
Yes, sir.
I just want to be sure that you are together. Sorry. Okay, so let's move ahead. Let's forge ahead. So that is the first aspect that we just look at. So I'm taking us to the next one, depreciation and what? Impairment. Now, under depreciation and impairment, what will the auditor do? Now, all the bullet points you see here are the questions the external auditor is asking. Are the questions the external auditor is asking the what? Is asking the client management. You ask them again. The depreciation rate that they have used in in the light of the assets, okay, they want to be sure that the depreciation they have used actually supposed to be what they should have used. For instance, there's a rule of thumb that when you want to use the depreciation for depreciation policy for motor vehicle, it's usually what? 25%. That is a motor vehicle can last for 4 years in the books of any organization. But sometimes some organization might say that, oh, our own, it can be just be for 3 years or 2 years because we use the vehicle more than any other, for other uses than any other organization. So we cannot afford to do it for what, 4 years. We only do it for what, 2 years. So provided they can support this argument, it's left for the auditor to see whether there is some form of what, reasonableness in their position. Okay. They also need to ensure that the calculation method that has been used has been applied consistently. It's not that they use one this year, the next year they use another one, 3 years ago they use another one. Whatever method of division you have selected to or you have adopted to use, it should be applied what, consistently. The author will test that, okay? The author will also review whether there are gains or losses on what, on disposal of what, assets. Because sometimes when you sell assets, you make gain, and sometimes what, you make losses. And that's why they say that for Toyota vehicles, they have what, second-hand value. Before, they bought a Land Cruiser for about, I've used that Land Cruiser for 4 years. Guess what? At year 4, this Land Cruiser was still looking like brand new. And the director that has this car decided to sell it. Guess how much he sold the car? After the motor vehicle value is already zero in our books, he sold the car for 5 million naira. So you can see there is a gain on disposal in that instance. So in the gain on disposal, you have to take into cognizance the accumulated depreciation from the time the asset has been in use to the disposed. That needs to be also be deducted from that value to arrive at what the actual gain or loss on disposal is. Do you understand? Then you also need, and I said that there's need to also consider the possibility that the asset may be what, obsolete or suffering from what, impairment. And I gave an instance of some organizations that they suffer from what, of a good example is if you have a client that sells phones, or you have a client that sells what, IT gadgets, or you have a client that sells what, or manufacture anything that you know that every year there always be an upgrade in that particular item, then that asset can suffer from what, from what, obsolescence. Land does not suffer from obsolescence. Buildings does not suffer from obsolescence. Furniture, well, maybe is debatable, right? But motor vehicles suffer from what, obsolescence. Computers suffer from what, obsolescence. Do you understand what I'm saying? And I know what obsolescence is. It does not mean that the asset will not be used any longer. It just means that that asset, right, there is an upgrade or there's an upgraded version of that asset. So the value of that one you are using presently will what, will automatically what, decrease. The market value will do what? Okay. Then the matter will have to be discussed with the directors of the client company, the right and obligation. Now, under the right and obligation, like I said, you need to establish whether the asset that has been added in the statement of financial position actually belongs to the what? Belongs to the client organization. Okay, you need to consider that. Now, how do you verify whether they are the owner? For land and building, you verify the what, the legal documents. Usually, it could be the CFO, certificate of ownership, or deed of assignment, or governor's consent, okay, or deed of agreement. These are the documents you'll be checking to verify whether this asset actually, this land and building actually belongs to what? Belongs to the client. Okay, from the side of the vehicle, you need to verify the vehicle particulars. You see, in a vehicle particular, there's one document they call what? Proof of ownership. Anybody that owns the vehicle must have what? Proof of ownership. So you ask for that proof of ownership. That document will always be there to show. Okay. Then other assets, you might need to look at the invoices or what they use to transfer the asset to the organization. Okay. For legal documents, bank document, another document for evidence for any loan. So if the client has imputed long-term loan or short-term loans in their financial position, you might need to also verify that those loans actually what exist. You're looking for the legal document, the loan agreement. Okay, you're looking for a document to show that that also exists. All right. Then under presentation and disclosure, right, you must check that whatever has been explained as part of the disclosure, they are clear and there are no ambiguity in it. That is, whoever reads the note to the account will not need to ask any question because it has been clearly written and well understood by any user or any internet user of the world or the financial statement. Okay, so you have an example here. This is the example. Whether I explain what you have been discussing since, okay? Now, during the year ended 30th June, year 6, construction acquired freehold land at cost 500,000 and built a distribution center on it using a mixture of subcontract and own labor. His distribution center cost total of 200,000 to construct. The construction was completed by the end of April. Required set the audit objective in respect of the above and the substantive procedure. Okay, and the substantive procedure you will carry out to achieve this objective. So what you need to realize here is that this is the way to go about it. The question is that you should what? Set out the audit objective in respect of the above and the substantive procedure you will carry out to achieve the what? The objective. They are not asking you to do any calculation here. Just to state the substantive procedure. Number one, you need to look at they explain to us that the land and the distribution center existed as at what 30th June. It's stated here. Okay, as at 30th June. You need to visit the site to confirm that the distribution center was built and is in use. Remember, how did you define assets? Anything that can generate an economic benefit. Okay, you see that it is in use. Then construction owns the land and distribution center as at that day. So you need to inspect the land registry certificate, that is the COO, certificate of ownership. Okay, to be sure that that asset actually belongs or has been transferred to the business or to the owner. Number three, you look at expenditure that has been incurred. Because you remember they said that where is it here? Cost the distribution center cost total of 200,000 naira to what? To construct. So what that implies is that this 200,000 naira needs to be what? Capitalized. You're not writing it off. It's part of the cost of the distribution center. You're not writing it off. So you have to capitalize the what? The expenditure. So you need to discuss with the management. Okay? Discuss with management their policy for capitalizing expenditure incurred in building the what? Distribution center. Okay? If a formal system is in place for the identification and capitalization of the construction expenses, then test the item. What that means is that if they have all the documents or they have posted it on their accounting software, okay, or ERP, you can look at all those transactions. You vouch those transactions by looking for the receipt, invoices to validate all those transactions that made up the what 200,000 naira. Okay, then the asset, you can see they say that the building was valued at cost 500,000 naira at cost, at the cost of 500,000 naira. You see it's there. What do? You need to inspect the completion statement for purchase of land. It is until after you finish payment that they're going to give you what the deed of agreement or C of O. If you have not finished payment, they will not give it to you. So you need to ask for it. You need to obtain analysis of cost of building and the distribution center. You need to inspect purchase invoices for a sample of what materials that were used. Something like cement, sand, sharp sand, okay? All of those things. You need to ask for the what? The document. Then You need to also review, recalculate the depreciation charge for the year. Take into consideration that the distribution was not completed until the end of April. So you're not going to charge the depreciation for the whole year. You charge it for what? For 8 months, from May 1st to the end of the year. Or if the company, like the company makes up the account to, let's go back to where the company, their year end is what? Is June. That means you're only going to calculate depreciation for 2 months, 1st May to 30th June. Do you understand? 1st May to 30th June. That is 2 months, okay? What you are going to use to calculate. Then the land and distribution center are appropriately disclosed in the financial statement. You need to look at if the information they stated as per those assets and the distribution center is clear to anyone that is interested in picking up the state of financial position or the notes to the account, read and what, understand. And you also need to ensure that the schedule of costs agrees to the figure in financial statement. So all the schedule of costs, all the costs that they said, all the costs they have incurred, they have the expense schedule. You need to look at the expense schedule. The expense schedule is the capitalized one. You need to look at it and see that it conforms or it agrees with the one that was explained in the what, in the case study. Is it clear to everyone? That's how to go about it. You can see there's no calculation. Some of us, when you see something like this, you see this in another, some people will start to want to get refrigerating, and they will be afraid. And sometimes they might start to calculate. As far as I know, the new syllabus has not made any reference to calculation in audit. So this does not require calculation. Look at what they ask you to do. Understanding the requirements of the question is actually part of the question. So what they expect you to do is to read and understand. Once you have an understanding of what the substantive procedures are for non-current asset, they have given you the non-current asset. Your non-current asset cannot be more than land, building, motor vehicle, property, plant, and equipment. And that's all for the tangible non-current asset. Okay? So we are going to the intangible non-current asset now. But before we forge ahead, is there any question? Is there any comment? Is there any observation or contribution from any one of us in the house? Are there questions, comments, observation?
Over here, none, sir.
Are we good to go? You said? I didn't
I
get you,
said
sir.
over here, none. Over here, none, sir.
Okay,
No
thank you.
question.
All right, thank you very much. Thank you. Thank you very much. So I take that as the consensus response from everyone. So I proceed. So we have just explained the tangible non-current asset. Now we are going to the intangible non-current assets. Okay. Now for intangible non-current asset, we are looking at goodwill. Examples of intangible non-current asset: goodwill, patent, okay, intellectual property, branding. These are examples of what? Intangible assets. So they also have their own substantive procedure. Okay. Now, the main essence of this is also to ensure that the risk of material misstatement, okay, that relates to intangible assets are what? Are also considered. Okay. So you are going to lay emphasis on, just like we explained in the first one, lay emphasis on the substantive procedure on the what? On the existence. That is, this intangible asset, does it actually exist? So how do you know that goodwill exists? Most times you determine goodwill when there is what? Acquisition, or when there's a takeover. Okay? That's when you calculate what? You calculate goodwill, purchase goodwill. Okay? And it's at that point you also determine the value. What's the value of the goodwill? Okay? That's when you also determine what? What's the value of the goodwill? Now, remember that the only intangible asset that can recognize in same financial position are what? Purchase goodwill. Okay, they said what is purchase what? Goodwill. Or intangible having a readily ascertainable market value, such as development cost, as subject to IAS 38. Now, remember, if you go to IAS 38, you have research and development. there. Now, research will not form part of what purchase goodwill because you have not established that that has been what that has occurred or that has been concluded. Okay, so it's just like it's a sunk cost, money that you have just invested or you have utilized, you have expensed it. For developmental cost, right? That means that you have already ascertained there's something that can be gotten from that particular project. Okay, so there is something valuable that can be gotten. Hence, you can what hence you can apply what IS 38 to it. IS 38 is talking about what um intangible assets, right? Talking about intangible assets. All right, so that is what we talk about in this place. Then, when the only procedure you're going to perform or the main substantive procedure you're going to use here, let's consider the what we can use. That is the purchase goodwill. Now, when you how do you test how do you vouch that there is purchase goodwill? So the test listed below relates mainly to the valuation of what purchase good. Number one, confirm that the business was acquired and confirm that the consideration paid for the business acquired. So like I said, most time you determine goodwill, purchase goodwill when there is what acquisition or when there is a takeover. That's what you determine. So when by the time you look at the purchase consideration with the value of the business, what is left after you have deducted the purchase consideration is the what? Is the purchase goodwill. Okay? The excess is what we know as what? The purchase goodwill. Then you review the reasonableness of the valuation placed on the net assets acquired. Okay? You need to also review the reasonableness of the valuation placed on the what? On the net assets acquired. Okay? Net assets here means you have look at all the assets less what? Liabilities. All the assets what? Less liabilities. What we know as what? Net assets. Okay? That is, your asset is more than your what? Liabilities. Okay? Then check the calculation of purchase goodwill. And the purchase consideration is what I just explained now. Purchase consideration, purchase consideration minus fair value of net asset. That is your purchase goodwill. Okay? Then review the possibility of any impairment having what? Arising. That is, maybe it has occurred. Okay? Then ensure that any impairment loss has been correctly calculated and recorded in the ledger. All right, all of these are what you do, are the substantive procedure you are going to do, or the rest of these rest of details you are going to do that relates to what purchase goodwill. Okay, then the next one, other intangible assets. The test of details for other intangible assets, excluding development costs, are this one. So the test for other intangible assets, other than development costs, are similar to those that have been applied to the what? Tangible non-assets. All what we discuss other tangible non-assets will be what? Replicated. Will be what? Replicated here. Okay? How will it be replicated? So the auditor, first of all, look at those assertions. The existence, completeness, okay? Right and obligation, right? The presentation and disclosure, all of that, the auditor is going to check everything in this instance because these are what we discuss under the tangible non-current assets, okay? The auditor will confirm the existence, the cost, and the client entity legal right to acquire the assets by looking at what purchase documentation. The auditor will check the amortization calculation for accuracy using entity stated policy. Okay, the auditor will also consider the possibility that the assets are suffering what impairment. So the matter may have to be what discussed with the what directors of the what of the company. Then the auditor will also ensure that any impairment has been correctly dealt with in the ledger. Okay, that is all impairment. As the what when you have a loss on revaluation or you have revaluation surplus, you are going to consider the treatment as well. This is for other intangibles, excluding development costs. Okay, for development costs, right? We're looking at test of this transaction for development costs here. Like it says, IAS 38 states that an intangible asset arising from development or from the development phase of an internal project that recognize and it can demonstrate all the following technical. Now, like I explained earlier, you have research costs and you have developmental costs. Research costs usually what? Expense outrightly. Okay? However, when the project, you're trying to embark on a project and you'll be able to ascertain it's viable. You have ascertained there is what the viability of that project, right? You start, that is when you start to recognize that cost as what? Development cost. Okay? That's when you start to regard it as what? Development cost. Do you understand what I'm saying? Then when you start to write as what? Development cost. So if you, once you have considered it as what? Your development cost. Now, these are the questions the editor will be asking the client management. Number one, the editor wants to know, since you have it in your books as development costs, the editor wants to know the technical feasibility of completing the intangible asset so that it can be available for use or sale. Okay, so what do I mean by this? So we are looking at let me look at something that is practicable. So you have a real estate company, Adlon Homes, okay, or Merit Abode or Revolution Plus, right? They talked about the fact that they they are trying to acquire a land. Let's say the land along which side now? Along let's say along Ife Road, okay, Ife Road. They have made payments, right? They've made payments. They've started some level of what? Construction. Now, and what would the auditor be requesting for? The auditor will want to see the title that the land and the one acquired because it's a project. They don't want to see how much has been invested so far. But let's say they have it in plan that, oh, we intend to buy a land along Ife Road. They have not bought it. Or maybe they made some commitment, they have not finished making payments. That cannot be considered as what a development cost because it has not been established at all. There's no commitment. Once you have not finished payment, there's no commitment. Okay? Or you're looking at a car manufacturing company. You know what is the rave now is that you want a car that can what? That can use less fuel. So you build what? Electric car. But let's say we have let's look at Dangote Pojo Automobile Nigeria, which is situated in Kaduna, that wants to start a project on what electric cars in Nigeria. Right? Now, if it's just a media hype, they just put in the media that they will start also as they've not started. That means it can still be considered as what? Research stage. Any call they incur at that point will what will be written off. But let's say Dangote has brought in what equipment, has employed the engineers that work on it. Okay? In fact, they've started work. They have a factory where they want to start production. So if at that particular point in time, that is no longer considered a research because there's a viability that this thing will come into what? Into future. Another good example is the refinery that Dangote just built. And at the time when he conceived this idea years back that he wants to build a refinery, provided that refinery project has not started, it's still considered as what? Like research. But the moment he starts, he acquires the land, he employs people, he takes them abroad for training, he buys equipment, he buys all the things that he need to make the realization of his dream to come to pass. That means at that point, it has become what? A developmental cost or development cost to him in his books. So he starts to what? Capitalize the cost because at the end of the day, that's how he's going to be able to determine, oh, this my refinery is worth X billion dollars. That is how he gets to it. Because he has started to what, capitalize its cost. Once it has passed the what research stage, it has moved to what development stage. Okay. Then another thing also we need to be looking at is the intention to complete the intangible asset and use or sell it, just like Dangote refinery. Does it have any plan to sell the refinery or wants to use it? You can see it's using it. You will also be asking its ability to use and sell the intangible assets. Then how the intangible assets will generate probable future economic benefits. We will have done what a cash flow forecast for the refinery. How much did they make in the first year? Second, how much does it intend to make the second year? And for the next 5 years, how much? You'll have looked at what the cash flow forecast. So you're going to tell that is what is practicable or is reasonable. Then you look at the availability of adequate technical, financial, and other resources to complete the work developmental or develop. Yes, I'll continue. I'll continue from where I stopped before the thing when the network interrupted. Okay, coming. I was explaining the test of detail for developmental or development costs. This was what I was explaining before it went off. And I was trying to explain using an example, something you can relate with. I gave an instance of Dangote refinery. That is for test of detail for development costs. I give an example of Dangote refinery. And I said that first of all, it started as what? As a vision or a research that needs to be done. So any cost that is attributable to research is usually what? Expense, outrightly. But when there is a visibility that or possibility or viability that this project can actually be, can actually materialize, then it can be classified as what? A development cost. Okay? So that is where you now start from. So the auditor will be asking the management questions like why did you categorize this as a development cost in your books? So we'll be asking them questions. The question we'll be asking them is that the technical feasibility, the intangible asset of the intangible or completing the intangible asset so that it can be available for use or for sale. That's an example of what Dangote refinery. When he started, after acquiring the land, what did he do? Engineers, he employed all the staff. Some of them had to send them abroad for training. Then they come back and what and build the refinery. Okay. They also want to look at his intention to complete the intangible assets. Okay. Now, mind you, as at the time the refinery has not been completed, is regarded as what a development cost. Once it's completed, it will move to tangible non current asset, but at the time of construction, okay, you can consider that as what development cost. Please don't get it twisted, right? Then you look at you want to be asking the ability to use or sell the intangible asset like after completion or while it was still being constructed. Whatever is going to come out from this refinery, will they be able to sell it? Okay. Then you also need to look at whether the intangible asset will generate probable economic future benefit. You have to do what a cash flow, if projected cash flow for 5 years to see how much you're going to get upon what completion. Okay. Then you also look at what the ability of adequate technical, financial, and other resources to complete the development project and use or sell the intangible assets. At the end of the day, when they are done, will be able to sell it, the diesel, the petrol, the jet fuel, and the likes. Okay. Then you also look at the ability to measure reliably the expenditure attributable to intangible assets during his work development. So all the costs. That's when after the completion, that's when you can say that my refinery is worth X billion dollars because it's been able to what attribute all the costs. Okay, aggregate all the costs and arrive at what the true net worth or the true value of his refinery upon what upon completion. All right. So the auditor, we need to discuss the development project with management. You will ask for the plan. Later we ask for the plan for the management. Can we see the plan that this project is actually in process? Okay. Then the auditor will review projections and forecast for using resources and generating future economic benefit. Look at the cash flow, created cash flow. Look at the assumptions. Look at the assumptions, the estimates that they have used. Okay. Then they also assess what production and marketing plans and whether a market actually exists for the products, such as the AGO. At the time they are producing, they say they want to start making AGO, PMS, and the likes. If they have a ready market, the answer is yes. Okay. Then consider funding requirements to completion. Like you remember, federal government had to invest in Dangote refinery. I think they are okay. Dangote got about 30% of the cost of completing that asset from federal government. Okay. You look at it's part of the funding, okay, funding requirements. Then whether the entity will actually be able to use or sell the asset at the end of the day. Okay. Then discuss management intention to complete the asset and either to use or to sell it. All this you talk about it. Then inspect development contract and record supporting and safeguarding patents. So you look at all of this other documentation to verify that these things are not fictitious, but it's actually going to come into what? Come into existence. Okay. Then the author will also test controls around the documentation and safekeeping of science notes, discoveries, and what conclusions. Okay. Then test a sample of development costs for appropriate capitalization. Another example I can use here was vaccine when it was launched in 2019 or when it occurred in 2019 to 2020. That could also be, all right? Okay. Then obtain representation from management. Sorry about that is the network. Let's continue from where we stopped. We're explaining the development cost under the intangible, right? Intangible. So final procedure for intangible assets, okay? We're looking at discuss management intention, that is whether to complete the asset or after completing the asset, they're going to use it or they are going to sell it. Okay, inspect development contract and record supporting and safeguarding patents. You look at the cost. Okay, look at the cost, what documentation regarding. So inspect development contract and record supporting and safeguarding patents. You need to look at that. As I get an example of the COVID-19 vaccines, okay? Then test controls around the documentation and certification of scientists' notes, discoveries, and conclusions. Then test a sample of development costs for appropriate capitalization, all right? Then obtain written representation for management as to their commitment to complete the project and either use or sell the what? Sell the assets. All right. So those are the substantive procedure for the development cost, then other intangibles and the purchase goodwill. Any question? Any question? Any comment? Any
No
comment?
comment. No comment.
Are we good to go? So we go to the next area we're going to look at is substantive procedure. Remember, we just completed substantive procedure for non-current assets. This one is substantive procedure for current assets. Okay. So first of all, we need to look, like I said, this is the current assets. Okay. So we look at what are those things that make up current assets? We have inventory, we have account receivables, we have bank, we have cash. Okay. These are the main ones, right? So let's look at this. The importance of closing inventory for audit testing. Okay, why do we need to close? Why do we need to close inventory? Okay, when you are doing audits. Okay, now for many businesses, although service organizations are often an exception, inventory is one of the areas needing most attention for the auditor. Why? Because it's susceptible to what? To privilege and what? Manipulation. Okay, so the auditor include so the auditor should ensure that inventory is often a material item in the financial statement. Okay, one of the reasons why the auditor is always interested is that it's often a material item in the financial statement. Okay, it appears both in statement of profit or loss and also in statement of financial position. Okay, the inventory may be a high risk area involving a high degree of judgment in areas such as what valuation. Okay, so that you can value your inventory also. Okay, for example, drawing may be needed to estimate the stage of completion of work or progress. Okay, inventory. You can need to what? Value it. For instance, in a manufacturing concern, you can value your inventory for raw materials, value your inventory for work in progress, value your inventory for what? For the finished goods. Okay, then inventory may suffer from deterioration, loss, or theft, and may also be recognized in the client financial statement. So, like I said, one of the risks to inventory is that it is exposed to what? Leverage. And sometimes deterioration, okay? Deterioration also affects inventory. Remember the COVID-19 era, that all the rights that they have stored in the palliative warehouses were almost getting bad, okay? Or turning bad. The inventory may be highly technical in nature. Where inventory is complex, therefore we need to consider whether to rely on the work of an expert. There are some inventories that are highly technical inclined, okay? So you may not be using for it to just count. You might need to use some expert to carry out some of these counts. All right. So closing inventory is often not part of the job, may not reveal misstatements what in inventory. Now let's look at this area. Analytical procedures are widely used to obtain evidence to supplement the detailed substantive procedure on inventory in the audit. Just like we discussed it in the substantive procedure for non-current assets, right? We still have the one for inventory here. So the principal risk that you face is the fact that it will be what? The value or the balance will be what? Will be misstated. Okay? Due to the following, that is not all inventory that is owned by the reporting entity will be what included in the financial statement. So it's going to test the completeness assertion. There's some inventory that has not been what included in the financial statement, even though, right? Maybe because the documentation is yet to be complete to determine what will be the value you are going to impute in the financial statement. Okay, that's one risk. Another risk is that inventory in financial statements are usually existing. Okay, because you need to verify when you say you have inventory, then we need to go and check that those inventory actually exist and it's to their amount that they have put in the what in the statement of in their financial statement. Okay, the inventory being incorrectly valued, so there's a risk of what valuation. Inventory IS2 says that inventory can only be valued using two methods, either average method, weighted average method, or use what first in, first out. Okay. Then the next one, sometimes you have inventory that belongs to what? Third parties. Especially when you are carrying out stock out. You need to ask the storekeeper, the store executive, all this inventory, do they belong to us or there are some goods that belongs to other parties or customers? You need to clarify so that you not go and double count. Okay? Then you not go and do a double count. Then inventory, you also need to check whether inventory has been disclosed correctly in the financial statement. That will lead to declaration and disclosure. What does that mean? So let's say there is a fire incident in one of the warehouses in Connaught. You need to put a note to that okay, there was a fire incident, even though you don't affect much of our inventory, but it will have an effect in the 2026 or 2025 financial statement. Okay, you need to also let that to be known, okay, to them. Then those are the principal risks of misstatement that can happen to what to inventory. What is the take home for this one now? Now, your take home for this aspect that I highlighted is that you need to use your assertion here. And those assertions, there are four of them under the assertion based on account balances that speaks to the stable financial position because your current asset is contained in your stable financial position. You look at your completeness assertion, you look at your price allocation assertion, you look at your allocation and valuation assertion, right? Then you look at existence assertion. Then lastly, you look at the presentation and disclosure also, because it also cut across all both the series of profit or loss and series of financial position. All right, that's for inventory. Now let's look at the substantive procedure for inventory. What is the substantive procedure for what? For inventory. Now, substantive procedure for inventory is that, like IS2 explains, okay, it should be valued at lower of cost or net realizable value. All right. So the cost will include the cost of purchase and other costs incurred in bringing the inventory to the present location, present condition and what location. You bought inventory from China. The cost you are going to bear from the point of purchase to when it gets to your factory will be considered under what inventory. Okay, be considered under inventory. Okay. The net realizable value is the estimated selling price of the inventory in the ordinary course of business minus any estimated cost to complete the items. Okay? Hence the reason why we always carry out stock counts, right? Hence the reason why we carry out stock counts. Okay? So there are several reasons for physical count of inventory. Number one, physical count may be fairly easy to arrange, particularly where most items of inventory are held in limited number of physical location. So sometimes that could be a challenge. Okay, in adequate space. Now, physical count provides evidence on the actual existence. Physical count provide evidence on the actual existence of the inventory. We tell you where they are, which of the rooms you have this inventory. Okay, and this evidence is important to the client company that's doing financial statement as well as to the auditor. The physical counts can be used by the entity to check the accuracy of inventory records where it maintains continuous inventory record. Okay. Then when the entity does not have continuous inventory record, the physical count of inventory is probably the only way to establish the quantity of inventory at the year end. Okay. All of these are what the physical count will also be able to determine. Physical count of inventory can also be used to check the physical conditions of inventory and whether there has been any deterioration of what in condition, okay, for those inventory that were tested or analyzed, okay, it is to be sure that they are still good, they can still be used, okay, or not. All right. Any questions so far? Any question, comments? So this standard, right, ISA 501. This standard ISA 501, which talks about the physical inventory count, okay, right? Or it talks about inventory as a whole as well, right? So what you say here is that the auditor should ensure that you obtain sufficient and appropriate audit evidence, okay, regarding the what? The existence and condition of inventory by attendance. So what they are saying here is that look at the physical count. The only way you can check that the physical count has been done, you look at the attendance of the officers that are present, okay, the time, the locations, okay. At the end of the day, you're able to determine and compare what you have physically with what is obtainable in the what? In the system or on the system. Okay. So you need to evaluate management instruction and procedure for recording and controlling the result of what? Of the count. They have procedure, okay? They said at the end of the count, you need to do what? You need to, every participant need to what? You need to sign, okay? Then observe the performance of the management count procedure. You need to look at some the internet will be checking to be sure that the physical stock count is going as planned. The estimator will also inspect the inventory and perform by inspecting the inventory, trying to check that the quality of those inventory they are still in order. Okay, perform test count. Then you need to count some of those inventory. Okay, perform audit procedure over the final inventory record to determine whether any accurate whether they accurately reflect the result of the count. You need to check and agree on the count, all the parties involved, and you need to sign off to show that everybody agrees with with the final uh, position of the count. All right. Then the agency may take any of three approaches of the timing of physical count. That is, the physical count can also be timed from three approaches. That is, annual count at the end of the reporting period. We call it periodic count. That's what they call it. Yeah, end of year stock count. They have the annual count shortly before and after the end of the reporting period. We call that one periodical counting. So what they do every month, organizations, go to one that they are doing stock counts. It's called periodic counting. Okay. Then you have continuous counts at a variety of dates during the period. So that one we call perpetual. That means you just count. The ones that you have in some of these supermarkets, they are perpetual. Okay, you don't wait till the end of the month before you do stock count of supermarkets. Otherwise, things will have got worse than what it is. Okay. Now, audit work relating to the inventory counts, okay? So the main financial statement assertion addressed by the auditor's attendance of the inventory count is existence. So one of the reasons why you do inventory count is to verify what the existence or to confirm the existence of what of the asset. Okay. However, the auditor work at the court or at the count and after the count, we also generate evidence relating to valuation, okay, ownership, that is right and obligation. It is convenient to deal with auditors' work on inventory count under the three headings. The auditor will need to plan. So when you want to do stock count, you need for what? A plan to be made. Okay. Then during the count, the auditor will also review, record, and observe. And after the count, we do what? A follow-up on the recommendations to be sure that those recommendations are what? Are approved and what? Implemented. All right. Now, audit work during the count, observing and recording. What is the purpose of attending an inventory count? Okay, the auditor should attend inventory count by the client for the following reasons. Number one, for test of controls. Okay, to ensure that the inventory count is carried out by the client entity employees in accordance with with their requirements. Okay, then you have a substantive test or substantive procedure to ensure that there are no material misstatements at the assertion level in the client financial statement. That is, there are no risk of material misstatement at the assertion level in the client financial. That is, we are sure that there are all the information needed or required has been what has been supplied. Okay. So what that means is that you are not just checking the inventory exists only. Okay. There are other areas you might need to also consider during the count. All right. Let's use this example to wrap up this evening. Okay. Example: you are the senior in charge of the audit of inventory as spares are us. Inventory is comprised a large quantity of spare parts for the car industry. Okay. Spares are us operate a perpetual inventory recording system. Okay. Backed up by a rolling program of the physical count during the year. Okay. Then physical count during the year, we're reading the case study. There is no year-end physical count inventory count and the amount of inventory in the year-end financial statement is based on the computer record. If required, briefly summarize the procedure that would undertake to obtain evidence on the amount of inventory in the year-end financial statement. So as the auditor, what should you do? You need to carry out spot checks. But you said you're going to be doing it at week. You have to carry out spot checks at all hours, okay? To be sure that it is there. You need to conduct sample counts at year end and compare the perpetual record and investigate any differences or variances, okay? What that means is that rather for you to sample to take stock out of all the items, since you have a manufacturing concern like Kibita now, right? You only audit the EVAP section or you only audit the beefy section, okay? Or the supervised section only. Just for you to be sure you are taking a sample because you know that once you're taking that sample, the appropriate sample is also going to assist the auditor when he's writing his audit reports, okay? Then review the results of the rolling count and ensure any difference from book to actual are investigated and adjusted. Okay, then check the auditor will also check a sample of cost prices to purchase invoices. Okay, they also need to assess what obsolescence. All right, and lastly, right, consider the use of audit software on the year-end inventory file. All right, so that is then what did we say we should do? Let's go back to the requirement of the question. Really summarize the procedure that would undertake to obtain evidence on the amount of inventory in the year and financial statements. Okay, so that is what they ask. Let's look at the other areas. Possible control weaknesses in an inventory. So control weaknesses are some of the things that will lead to control weaknesses that have been observed by the auditor. We include failure to pre-number the count sheet. You need to number the what? The count sheet, okay? The count sheet that you use for the inventory counts. Then including on the count sheet for each inventory item, the quantity of the inventory as recorded in the entity's inventory record. What that means is that when as accountant should do module up your inventory count, you should just use one paper or one page for a particular count, okay, so that it doesn't get mixed up. Then entering the quantities counted in the what? In the count sheet in pencil. Now, once you realize here, this is giving us the step-by-step procedure for stock count. That's what is explaining here, okay? Then the store staff we commonly use, the store staff are commonly used to do the counting because they are the owners of the inventory. So they should know their inventory just like the palm of their hand, okay? The inventory may not be marked when it is counted, okay? Then count sheet may not be signed by the individual counter who prepares them. That is, like I said, you need to reconcile your store count both with the accountant and the store and agree on the position, okay? Then lack of precise instruction to the counting team. That's another area that the auditor sees that could be what weaknesses. Okay. Now, cost of raw materials and the cost of goods sold purchased for resale. Okay. For raw materials and goods held for resale, the cost of inventory will be the actual purchase cost of the items plus any cost of delivery that the entity may have had to pay. Okay, the editor should carry out the following test for valuation. So what we are saying here is that when there is a need to look at the cost of raw materials and the cost of goods purchased for resale, right? That there are some tests that we need to perform to validate what you have. Confirm the approach adopted by the client company to estimate the cost of materials or goods sold. Okay. Then number two, that's what they are saying here is they either use weighted average method or first in, first out. Number two, check the figures for the cost of inventory by comparing them with prices in purchase invoices and suppliers and price list. Okay? Are we together? Are you hearing me? We'll soon be through with inventory, okay? Once we are done with inventory, we are going to stop, all right? So let's just conclude inventory. You can see that you just need to show us that we are almost through, okay? Now let's look at cost of manufactured goods and work in progress. You know, inventory is made up of three: raw materials, work in progress, and finished goods, okay? All what we have been discussing so far has been what? Finished goods. Let's look at work in progress, okay? For work in progress, right? The editor needs to check each of the elements in the cost, that is your direct material, direct labor, and your direct production overhead, okay? You need to check all of that. So the editor will need to obtain schedules showing the markup of the cost figure for each item of work in progress. So there's a markup of the cost figure, that is, how much do you produce, or can we produce this product? How much can we sell it? That's what they mean by the markup uh, of the cost figure, okay? Then check the accuracy of the calculation. You need to recheck the calculation to be sure that there are no mistakes there, okay? You need to perform substantive procedure as for raw materials above and check that the correct quantity of materials has been used in the what? In the valuation, okay? Then you need to under labor, you need to check the pay. You know, direct labor is under what? Under the cost, okay? It's under the cost of production, okay? You need to check the pay rate for direct labor, cost against payroll, personnel, okay, of the employee. I mean, for the employee who produce the work in progress. Then check the hours you used, okay? Because at the end of the day, it's going to account for either overtime or account for normal salary, okay? You need to be very, very intentional about this, okay? Then under production overhead, confirm that only production overhead as opposed to selling and distribution or selling and administration overhead are included in the valuation, okay? Then confirm the overhead absorption rates are based on the normal levels of what? Output, okay? All of these are work in progress, okay? Work in progress, in addition to the above test, the auditor may also need to check the stage of completion of the work in progress. Because at the end of the day, for instance, you are doing stock count at the end of the day, that is, let's say on Sunday. So you should have been able to determine um, what is the cost, okay? You look at the overhead assumption rate, okay, based on, right? The auditor will need to check the stage of production. Like I said, you are still producing as at 29th. So the cutoff will now be on the 11:59 of the next day. That makes the circle complete, okay? We're now going to a new month. I hope that is clear. I'm trying to explain how you do the stock count, okay? Then what do you mean by cost or net realizable value? Why is that, what are we explaining here? What we are trying to say here is that you need to look at the net realizable value of the inventory, okay? What do you mean by net realizable value? That you want to sell, if you want to buy this, you want to sell this inventory now, how much will it cost? That's net realizable value, okay? That what we mean by net realizable value as against the cost, all right? So you need to look at it from the angle of you need to look at it from that angle, okay? So the editor should also look at the procedure for the client entity for deciding whether each item of stock should be valued at cost or at net realizable value. The editor may therefore carry out the following tests: review and test the procedure in place for comparing net realizable value with cost of each item of inventory. Number two, follow up any information obtained from other audit work suggesting that for certain items of inventory, what they are saying here is that there are some items of inventory that are prone to deterioration, okay, or getting spoiled. You need to also be able to factor that. and give them a discount or returns in this regard. All right. They need to review inventory records and other books, okay, for evidence of slow moving items. So it's when you do that, you need to analyze your inventory and say these are slow moving items and these are the cash cow, okay, of the organization. All right. What you need to also note here is that in the case of work in progress, compare costs incurred to date with selling price minus cost to complete net realizable value. Okay, estimated cost to complete may be assessed by the auditor from the client management record. Okay, so we are going to stop here for tonight. We'll take it up next time. Substantive procedure for trade receivables and repayment. Any question? Any comment? Question, comment, observation?